Good afternoon. My name is Kim Schoenholtz, and I'm delighted to welcome you to the 17th NYU Stern Economic and Market Outlook Forum. The host of today's forum is the Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as students and alumni. We're pleased today to have in the audience students and faculty from all over NYU, as well as many alums. Thank you very much for joining us. While this forum is the first that we are holding remotely, the program remains largely unchanged. The session will last about 80 minutes. It will begin with presentations of 5 to 10 minutes each by each of the panelists about economic and market prospects, followed by audience Q&A. We'll finish by 6:30 p.m. For the Q&A session, please enter your questions through the Q&A mechanism in Zoom. In moderating the session, I'll try to limit repetition by grouping similar questions together, some of which we've already received from students and faculty. Please note that anonymous questions are not permitted. Let me now briefly introduce our distinguished panelists. Elga Bartsch leads economic and market research at the BlackRock Investment Institute, where she's a managing director. Previously, she was global co-head of economics and chief European economist at Morgan Stanley in London. Dr. Bartsch is a member of the ECB Shadow Council and a trustee of the IFO Institute. Earlier, she chaired the Economic and Monetary Policy Committee of the German Banking Association. Dr. Bartsch received her PhD in economics from Kiel University, and she joins us today from London. Julia Coronado is the president and founder of MacroPolicy Perspectives, where she advises clients on U.S. and global developments. Previously, she served as chief economist at Graham Capital Management and at BNP Paribas, following 8 years as an economist at the Federal Reserve in Washington. Dr. Coronado is a member of the New York Fed's Economic Advisory Panel and of the Board of Directors of the National Association of Business Economists. She also teaches at the University of Texas, where she received her PhD in economics. Rebecca Patterson is a senior member of the investment research team at Bridgewater Associates. Previously, she was chief investment officer at Bessemer Trust and a member of the management committee. Earlier, Ms. Patterson served as chief market strategist for JP Morgan Asset Management. She's a member of the Council on Foreign Relations and the New York Fed's Investment Advisory Committee. American Banker has named Ms. Patterson one of the 25 most powerful women in finance. Finally, for the hometown attendees of today's forum, Rebecca received her MBA here at NYU. I'm sure if this were a live audience, they'd all be standing and applauding right now. So Elga will now begin the presentations, followed by Julia and Rebecca. And after their brief initial remarks, we'll begin the Q&A session.
Thank you very much. It's a pleasure to be here and to have the opportunity to outline some of the key topics that sort of are posed by the very unusual macro environment that we find ourselves in at the moment. So just before I go into some of the details of our views, I just want to say at the outset how different the world is after the COVID shock, which was sudden and deep, and thus makes everything that's going on at the moment very different from a normal business cycle. But what is also important that it's accelerating a lot of structural developments, long-term developments that were already in play before, things such as deglobalization, macroeconomic policy coordination, or sustainability trends. So I'm going to talk about how we see the macroeconomy evolving in the aftermath of this shock, and again, why things are very different from a normal business cycle, and thus we need to look at different indicators and how we actually are scaling this shock and comparing it to the global financial crisis. But another, so that's the first set of comments I'm going to make. The second set relates really to the policy response, which is the main explanation to the positive response by risk assets that we had very quickly. But what is important is that we really have not just only seen an unprecedented policy response, but also a very quick coordination between fiscal and monetary policy that is nothing short of a policy revolution and will have major long-term consequences. So I do want to talk about those. And given the structural shifts that I explained, one element that we think is very important to stress, and I think COVID-19 sort of brought that point home. The future consequences of climate change will also emphasize this, which is really the need to build resilience into portfolios. And I will try to explain a little bit about how we would do this. But let me actually show you a couple of slides to underpin the arguments here. So one thing that I just briefly wanted to comment on is really how the COVID-19 shock compares to the global financial crisis, which especially at the beginning of the discussion of the macro discussion was a big sort of yardstick that a lot of people use. This is very different, not only because it's an external shock, but more importantly, it's not the initial shock that matters the most, but what follows. And this is where we think that given the policy response that we have seen, both on the fiscal policy side, but also on the monetary policy side, that is bridging the gap, will ensure that at the end of the day, the cumulative loss in output over time is going to be much smaller across the global economy than it was in the global financial crisis, which actually caused a long-term downshift because it was followed by about 10 years of deleveraging. So we continue to think that there is sort of a material difference, and that we will get back to the pre-crisis growth trajectory much more quickly than we were able to do after the global financial crisis. And the fact that there was no major buildup of financial imbalances prior to the shock is an important factor here. So, this, even though it initially felt a lot more severe, that does not mean that the shock will propagate in the same adverse way that as the global financial crisis did. And so that sort of very early on caused us to be reasonably optimistic that the global economy and financial markets will be able to pull through this. I already mentioned that we believe that the normal business cycle analytics are not very meaningful in the current environment, partially because global economic activity was deliberately frozen for public health reasons. So as a result, a lot of economic data doesn't really have the usual information content that we usually cherish when we sort of analyze the business cycles. So like many other forecasters, we have started to look much more closely at virus dynamics and other measures of economic activity. Here you see infection trends on the right-hand side and Google mobility, which we think is a key sort of driver of the economic activity. And this allows us to track the restart of economic activity in real time. So we can show that mobility is driven by infections, and there is a sort of feedback mechanism between the two, and that mobility again has predictive power over economic activity. And one thing that we have learned over the summer, as we had spikes in infections in a number of places, is that it pretty quickly translates into flattening the pickup in mobility and eventually in economic activity. Again, it doesn't tell you much about the underlying health of the economy or economic dynamics. It just tells you, or as a consequence of what's going on the public health side. And that's why we also try to sort of emphasize that this is a restart rather than a recovery, just to stay away from the typical language that we would use in business cycle analytics. So this is really, the key cyclical dynamic for the moment as the economies restart. We think after the initial rebound, we probably will see more moderate growth rates in the remainder of the year and into next year, providing that we have ongoing policy support. And policy support is extremely important to bridge the gap that has been caused in various income streams and cash flow streams through the disruptions caused by the coronavirus. And the policy response, which was very swift in coming along, was, in our view, one key driver of the strong market performance, because the market very quickly understood the external nature of the shock and that monetary and fiscal policy were coming together, and that we think explains to a large extent the positive market response that we have seen. So we don't really see a major disconnect between market prices and the real economy, both in equities or credit markets. But the market dynamics also sort of are a reflection of what we see both on virus dynamics, especially in some of the near-term dynamics, and then longer-term, what's happening in policy. So what is happening in policy then? One element that I already mentioned at the outset is really a full-blown policy revolution that is happening in real time. And that policy revolution was rung in by the fact that policy rates, monetary policy rates, are sort of hitting their lower bound. And so monetary policy space was already constrained going into this. But more importantly, the nature of the coronavirus shock implies that really easing financial conditions would not have solved much of the disruptions that we saw in income and cash flow streams. So there was a clear need to go direct and to provide funding directly to the private sector. And what we have seen increasingly happening on both sides of the Atlantic is that central banks have gone directly to the private non-financial sector, bypassing part of the financial system in order to make sure that the funds need to go where they're needed, and supporting the economies in the US and in the euro area. This has caused a much closer coordination between monetary and fiscal policy, because many monetary policy authorities are embarking on policy measures that de facto have some fiscal aspects. Often they would do this in coordination and with the approval of the fiscal authorities. So we have really moved very quickly forward into a de facto very close coordination between monetary and fiscal policy. And I would say it's probably fair to say that at this juncture, fiscal policy has really taken the lead, and monetary policy, which historically has done most of the heavy lifting, is primarily providing an assist to keep the financial system liquid and also making sure that financing conditions are supportive. But this has caused many central banks, and first and foremost the Federal Reserve, to enter unprecedented territory with a whole set of new QE programs, special purpose vehicles. And on our count, they have done in the first 6 weeks of the current crisis more in terms of balance sheet policies than they have done in the first 5 years of the global financial crisis. So that just gives you an idea of the dimension of what's going on. So, and then last month we heard from the Federal Reserve about the long-term outlook in terms of its policy framework, the new monetary policy strategy. And that, I think, is quite important for the long-term outlook, in particular for inflation, because not only has did the Federal Reserve, as was expected, move to flexible average inflation targeting, promising in the future to make up for any misses on the target in the past, but it also sort of has changed the language around how it looks at the full employment objective by now stressing that it would really mainly consider the shortfalls from full employment in its policy decisions. And that, I think, means that the Federal Reserve will tolerate inflation overshoots. It will worry a lot less about labor market overheating as a signaling a potential future inflation risk. And that, in the setup with close policy coordination with fiscal policy, might potentially make it a lot more difficult in the future to tighten monetary policy again when inflation starts to pick up, because the political pressure will likely be immense on monetary policy makers in the light of the materially increased public debt loads that we see in many industrial countries coming out of the crisis, not to mention also the increase in private sector debt. So the need for low interest rates to keep these debt loads sustainable and protect financial stability will likely increase going forward. And the fact that the new framework potentially provides less guardrails around the central bank's ability to act proactively and sort of fending off some inflation risks is a concern. And for us, means that we most likely will be seeing an upward shift in inflation over the medium term. And with that, let me stop my screen share and get back to the panel.
Okay, so I guess I will just take the baton from Elga.
Yes,
and give a few remarks. Some of my remarks will dovetail very much with what Elga laid out just now. And then I'll try to focus on some of the areas where some of the nuances that maybe Elga didn't go into. Like Elga, for me as a macroeconomist, as a forecaster and policy analyst, one of the unique defining characteristic of this cycle is the pandemic. And that is truly what we would call an external shock. So it's not the result of imbalances that we developed in the economy over time, like with the housing crisis or even arguably the internet bubble, but rather, a true shock. And the good news from that is that we don't didn't come into this with a lot of imbalances that would exacerbate or deepen the downturn. And in fact, some of the regulations that had been put in place by the Fed, requiring greater liquidity and capital buffers in the banking system, focusing on monitoring of systemic risks, meant that we had a financial sector that was in pretty healthy shape coming into this. The banking sector did not exacerbate things by sowing the seeds of doubt. And so it actually served as a conduit for the Fed to help execute certain policies as they released those required buffers and sort of told the banking system, go out there, provide forbearance to people who are experiencing an interruption in income. So, again, the fact that we came into this with a pretty healthy economy is the good news. The bad news of it is that you can't recover from this cycle without a public health response. So the public health response and the pandemic are still very much front and center and will determine the shape and robustness of the recovery. That can be a good thing or a bad thing. And we've got many experiences around the world. I mean, the good news for researchers is that there's tremendous variation in policies adopted that will lead to various outcomes. In the US, the public health response has been poor. It's been lacking. It's been uncoordinated. We still don't really have one. And so what that has meant, so Elga describes, tracking the virus and the rise and the fall of the incidence of the virus, as well as higher frequency economic indicators, which I'll turn to in a second. But tracking the virus is a reliable leading indicator of economic activity early in the stages of the pandemic, when the concept was we're going to shut things down, shut the virus down, put in place a public health response that would allow for testing and tracing, contact tracing, so that we keep that virus at a low level. And then we can reopen and go back to the economy we had before. That was the original idea globally. That is not what we did in the US. We opened too early, and we now have community spread everywhere. And what that means is we now do see the virus coming down. What we saw first was an absolute takeoff of the virus in states where it hadn't been so bad. The southern states had not seen the incidence of virus that the northeastern states had seen. And so, in some senses, there wasn't the political will to stay shut down. There was this false narrative of it's the virus versus the economy. And so they reopened. They reopened prematurely. They didn't have the public health response ready. They opened too quickly. They saw the virus resurge. And I'm here in Texas. I'm at the epicenter of one of those areas. Now we're seeing the virus come down. But why are we seeing the virus come down? We're seeing it across the board in the southern states. It's because of social distancing. So once you have community spread, the whole shut things down, test and trace and reopen it no longer applies. Now, to bring the virus down, you need to maintain social distancing. So if, for example, we see the virus decline and then we say, okay, great, now the virus is low. Now we'll go back out. It's still too high an incidence of the virus that it'll just go back up again. So now we're kind of moving into this phase of the recovery where it's actually looking more like a normal business cycle. So this is where, because economic functioning requires social distancing to last. In other words, we can't just go back to the way we used to do things. We have to keep restaurants at low capacity. People are not going back to sporting events. Schools are not reopening in a normal fashion. We have to stay socially distanced. That means we have permanent disruption. So we have businesses that are going out of business. They just can't make it with 25% or 50% capacity, or they're in entertainment or tourism related industries that it's just not going to come back anytime soon. And so we are seeing rising small business failures, rising delinquencies. We're seeing still a very elevated level of layoffs, only now these layoffs are more likely to be permanent. So I see where we are as a rotation from the pandemic cycle, which was shut down, reopen, to a more normal recession. We're going to have permanent job losses. We're going to have shifting activity. So there are areas of strength and areas of restructuring and weakness, just like any recession. Right now, for example, housing is very strong. People are locked down. They're valuing their homes more. Interest rates are low. Credit is flowing. So for those who aren't experiencing hardship, they actually want a bigger home or a different home in a different area. And so we're seeing the housing market, lots of activity, lots of demand. Similarly, car demand is rebounding very strongly. People are less interested in taking public transportation. They're moving out of the cities into the suburbs. They want their cars. So we're seeing car demand be pretty healthy. Those are typically areas that are hit very hard in recessions. Recessions are usually centered in the goods sectors. This recession is centered in the service sectors. So you want to buy a home and a car, but you're not going to take a vacation that requires you to get on an airplane. You're going to spend less money going out to restaurants, less money on entertainment. So the service sector is the epicenter of this recession. So the composition is very different. One thing I will highlight, like Elga, I'm following as many of these higher frequency indicators because I think it's worth noting that the collection of economic data in a pandemic is extremely difficult. And the numbers that you're seeing will be subject to large revisions over time and are probably biased upwards. Lots of our official economic statistics are based on surveys of businesses, surveys of households. Well, if you think about it, who answers surveys in a recession? Well, people that are still operating normally. If you're in distress, if you're shutting down your business, or if you're out of business or you're unemployed, you're probably not taking time to answer a survey. And this is a known bias. We know there's GDP revisions that GDP is overstated in the initial estimates in a recession and then gets revised lower over time. Same is going to be true for employment. We get bigger benchmark revisions downward once the full data comes in and better source data is used to calibrate information. So I would just warn that, one, we're relying on a lot of high frequency indicators that have not stood the test of time. Two, the official statistics are probably biased and subject to revision. So my approach to all of this is just triangulating as much information as I possibly can, and looking at the sources of the data and whether it's hard information versus soft information, survey-based, and just taking it all with a grain of salt and just gathering as much as possible. And so that's just one caution for looking at this data. Also, I think Elga touched on this too. While, it's true we came into this with a very healthy economy, nothing was obviously wrong. It has revealed structural issues. I'm mostly focused on the US. Elga's, got the global perspective. Certainly in the US, lack of healthcare coverage, income and wealth inequality, racial disparities in terms of who gets hit and who loses jobs in a downturn. These have all been they just come roaring to the forefront when we get hit with a cycle, and particularly given this type of cycle. So not only do Black and Hispanic people typically see higher unemployment rates and a bigger gap between white and Black unemployment rates in a downturn. But COVID also hits those communities harder as well. So it's just a real, just one of the characteristics of this recession is just incredible yawning disparities in terms of who's getting hit. It's just taking the existing underlying inequalities that existed in the economy and just amplifying them. I think that's one of the reasons we see a lot of the social unrest that we see. There's a greater tangible sense and awareness of this that has been revealed by the pandemic. So quickly to touch on the policy issues. We have seen these new policy frameworks. I want to mention that, the Fed's new framework isn't the result of the COVID recession. It is the result of a long-standing reevaluation of underlying macroeconomic dynamics. So what were the motivations of the Fed's framework review? One, slower trend growth here and everywhere because of slowing population growth and a trend towards slower productivity growth, which may or may not last far into the future. Trend growth is low. Trend growth is lower. That also means that neutral interest rates are lower. So the Fed is closer to the zero lower bound on a permanent basis. And that makes it harder to stimulate the economy in a downturn. That also led them to the conclusion that the balance sheet was going to be a much more permanent, active margin of monetary policy than just interest rates. In a recession, you're going to hit the zero lower bound right away. You're going to have to turn to these balance sheet policies. And I think because that was already well understood before COVID hit, the Fed actually implemented this. We've been seeing monetary policy that's consistent with this new framework from the get-go. So one, even before COVID hit last year, when there was a global slowdown and inflation was low, the Fed saw those risks to the US economy and was willing to cut rates preemptively. Because they wanted to avoid a recession at all costs. And then when COVID hit, one of the lessons of being close to the zero lower bound and being more reliant on balance sheet policy is you just go big early. So they went straight to zero overnight and just blasted QE into markets. So they've expanded their balance sheet $3 trillion in a matter of months. And so they've already been putting this in place. And then the other macroeconomic reality that led to this framework review is the fact that inflation is less responsive to the labor market slack. So we got all the way down into the 3% on the unemployment rate. We were still falling short of the Fed's 2% objective. So they're just really, the Phillips curve is, if not dead, it's barely breathing. And now for the Fed, they've sort of formalized this. The Phillips curve is innocent until proven guilty. It is not a risk, creating a risk of inflation unless we see inflation. And so that really has recalibrated the reaction function. It's still an open question whether we can get inflation through the Fed's tools. So even though the Fed has recalibrated to this more kind of preemptive, aggressive reaction function, more dovish, their tools are less effective than they used to be. So in an aging society, with lower growth rates, the credit channel, which is the traditional channel of monetary policy, is less effective. People are just less interested in borrowing against the future because it's an older population on average, and there's less growth to borrow against for businesses and younger consumers. So the credit channel is greatly attenuated in a slower growing economy. And then you turn to the balance sheet tools, they operate through asset prices. And that's very, very powerful in terms of mitigating downside risks. So what the Fed did very effectively was short circuit a health and economic crisis from being amplified by financial markets in a financial crisis. They went aggressive early and short circuited that. In fact, we've got this kind of jarring easiness in financial conditions, even as the economy is struggling to recover and the pandemic is ongoing. That's good news. I mean, that's again, short circuiting that transmission is incredibly valuable and means that we will have a shallower recession, all else equal. And a quicker rebound. Things like housing that are rebounding quickly are doing so because the Fed has ensured the flow of mortgage credit. But because wealth is distributed so unequally, those higher asset prices benefit a very small slice of people. And so the transmission on the upside, in terms of generating a lot of growth, is less than it used to be. We identify with our model something called the wealth effect. It used to be that we thought 3 to 5 cents of every gain in wealth translated into GDP over a period of 4 to 6 quarters. It's very close to zero right now. So it prevents the downside, but it generates very little upside. So the Fed's tools in terms of stimulating consumer demand are less effective than they used to be. So that's leading some to call for a review of the Fed's toolkit, including myself, and some exploration of other tools. One last comment on fiscal policy. That has also undergone a transformation in thinking that was well underway before COVID hit. And you know, some of you, it often gets likened to modern monetary theory, but it's really just the realization that sovereign countries are in control of creating their own currency. And if they do so within a disciplined context of solid institutions and good, strong banking systems, then actually deficits don't really matter that much. And so the whole kind of the way traditional macro was taught, that there's this fixed pool of loanable funds that the government is competing for, and if they borrow too much, they'll raise interest rates and crowd out. That's just not how money is created. And so MMT has brought a more realistic understanding of how money is created, or even orthodox macro is sort of acknowledging that as long as R interest rates are below G nominal growth rates, the burden of deficits and debt are much lower than we thought. So the real constraint is full employment and inflation in the economy. Can we get the economy to full employment? How do we get there? Does the private sector get us there? Or are we going to have a lot more policy push to get us there? So I think the bottom line from all of this, and certainly from people operating in financial markets and global capital markets, is going to be a lot more fiscal and monetary involvement for the foreseeable future. And with that, I'll turn it back over.
Great. Well, thank you, Julia. And Kim, if you were hoping for a lot of debate and drama between the three of us, I don't know if you're going to get a lot of it, at least with our formal comments. Maybe when we get to the Q&A, we can have a little more drama and debate. But I generally agree with a lot of what's already been said. And I'd love to just quickly make 3 points in terms of how we're seeing the world today and our outlook. And the first one is going to pick up where Julia and Elga left off in terms of what we're calling a paradigm shift. And as we look at the world today, this happened. I joined Bridgewater at the beginning of January this year. And for the last year and a half or so, the firm was saying, we see this paradigm shift coming. Well, what is that? Well, basically, when we say that, we mean some structural change in how markets and market relationships work. And usually what happens is you'll have some sort of theme is the wrong word, but trend, lasting trend in markets. And in the last decade or so, it was a lot of liquidity lifting financial assets was part of that theme. But then that had other repercussions, which included growing inequalities, which Julia touched on. It included growing debts. It included growing conflict, both within countries and between countries. And at the same time, and both the other speakers mentioned, interest rates were coming down. Monetary policy was becoming less effective. There was less fuel in the tank to react if we needed to. And so we saw that the scope for a paradigm shift was coming, some change given all these conditions, and the pandemic fast forwarded that. So now we feel like we're in a new era, if you will, with different market relationships. And the one that Julia and Elga both touched on, which I think is so important, is this closer coordination between monetary and fiscal policy. And we look at it really kind of with three types of monetary policy we've had over the years. The first one, kind of what we think about when we go to school and we learn about monetary policy, is using that interest rate lever as our main tool. You know, if you have a strong labor market, rising inflation, the economy is threatened by overheating, you start raising rates, raising borrowing costs, and that cuts spending, which feeds into lower incomes. And that worked great until interest rates got basically to zero. And if you're going to cut interest rates 400, 500 basis points, typically in a recession, and you don't have that, you have to move on to something else. So that took us to what we might call monetary policy 2.0 or MP2, which was the greater use of quantitative easing of asset purchases. And as Julia mentioned, I'm not sure if Elga did as well, but that certainly helped. But its main effect was pushing down yields, lowering borrowing costs, pushing investors out the risk curve, into financial assets. So it created financial reflation, but it didn't necessarily feed into the economy directly into consumers and businesses the same way. And so while it did help support economic recovery, it also exacerbated the inequality problem that we're facing even more so today. And so when we got to the pandemic, it was clear that, and Julia mentioned, I agree, that QE, asset purchases, could help provide liquidity to the financial system to make it not worse. But would it be enough to actually help businesses and consumers? And it isn't. And so you had to get to monetary policy 3.0, MP3. And this is part of this paradigm shift we're talking about. We think we're in a new structural relationship between fiscal and monetary policy, where fiscal policy is doing the heavy lifting. It's getting the money directly to businesses and consumers and helping the real economy recover. And the central banks are facilitating that by printing and then buying assets to keep borrowing costs very low. And we think that's the world order we're going to be in. Now, one thing I'd add to what's already been said is that while monetary policy in the relative scheme of things is fairly straightforward to predict, if you have a view on where inflation's going, where the labor market's going, you know what the central bank reaction functions are, you're good. Fiscal policy is a totally different world because you have human beings, you have politicians who have a lot of different goals, whether it's looking out for the national economy, their local constituents, their party, are they worried about debt, are they not worried about debt, et cetera. And so predicting fiscal policy is much messier. Understanding when we're going to get it, when we're not, is messier. And that has implications for financial markets, for investors, because you could have stop go, right? You might not have that steady, predictable policy that you did with central banks. Now it's going to be less predictable. That suggests, all else equal, more volatility in the markets, more uncertainty than we had before. So that would be something about MP3, this fiscal monetary coordination that I would highlight. So that would be the first point I'd make in terms of big themes shaping how we're looking at the world going forward. The second one I would highlight is just this idea of differentiation. And while the pandemic is horrible, and I much rather wish it had never, ever happened, and we were all in person having a great conversation in the auditorium today, the one thing as an investor that maybe if there is any, you can't even call it a positive side, there is no positive side, but one thing that's come about with the pandemic is differentiation, which creates a lot of investment opportunities. And what I mean by that, there's really three things that are creating this differentiation, both between economies, sectors, and even companies. And one is just the virus response. So you had places like China and Korea that locked down hard and very quickly And so we're able to get the virus under control. And as Elga and Julia talked about, that affected how quickly we could get mobility back. So the virus response was one. The policy response is the second factor that's led to differentiation. So did we get a lot of fiscal stimulus or a little? You know, the United States had one of the most aggressive fiscal and monetary responses globally, and that certainly has helped our recovery. And then you have a place like our southern neighbor, Mexico, where we're actually seeing AMLO talk about fiscal austerity. So a very different response, which has implications for how the economy recovers from this. And then the third type of driver, if you will, for differentiation is just the makeup of the economy or the company or sector in question. So are we talking about an economy that's very service oriented, maybe very tourism oriented? They're going to get relatively hit harder versus an economy that maybe is more domestic focused and goods focused. And so looking at those makeups and looking at the virus and the policy response helps us see opportunities for different markets where we might want to be long or we might want to avoid. And again, it applies to companies and sectors as well. One thing with companies is a lot of companies did go in to this crisis already with fairly high debt, and a lot of them are coming out with even more debt. And so when we think about the health of different equities, different stocks, we can look at that differentiation as well. A company that's going into this, and tech's been very much in focus in the last week, given the volatility both on the way up and the way down. One of the reasons a lot of these tech companies were very much favored over the last several months is because they didn't have a lot of debt going into it. And obviously there's differentiation within the group, but as a whole. So you had a large cash on the balance sheets. You had organic sources of growth. They weren't dependent on an economic cycle to grow. They were seen as relatively resilient to the pandemic. And you compare a company like that to maybe a company in the energy sector that's going to be very exposed to the crisis and have a lot of debt. And when they come out of it, are they going to be able to invest and hire quickly, or are they going to be trying to clean up their balance sheet? And so that's another set of differentiation. So that would be the second big theme as investors as we look today and going ahead, making sure we understand all those differences so we can figure out the best way to position the portfolio. And then the third and final thing I want to comment on, just in terms of big themes as we think about where the world's going. And again, sorry, I'm being a little redundant, is the inflation question. And while it's not clear to us if we're going to get a lot of inflation or when, we think the scope for more inflation, both in the US and globally, the scope is greater today than we've seen in a very long time. And I really think about it as a pendulum that swung. If you think about the beginning of monetarism, the beginning of fighting inflation with Paul Volcker, and that pendulum's come all the way to the other side, where now central banks, starting with this new review of Fed policy, they're actually encouraging inflation. They're welcoming inflation. Please, let's get it to 2. Let's get it over 2. Bring it on. That is a huge shift. And even if it's a small step for the Fed in terms of thinking about its framework, it's symbolically a pretty big deal, to me at least. But are we going to get inflation? You know, on one hand, we still have question marks around globalization, around capital versus labor. We still have question marks around what demographics could mean, or some of those other structural factors. At the same time, we have all this tremendous fiscal stimulus going into the real economy. And if you have that plus this incredibly easy monetary policy, I think the scope is there that we could see inflation come back. And then the question is how much, how quickly, how do you think about investing around that? We haven't had to think about that kind of environment in a very long time. So things we're thinking about, I'd say the one I'd highlight most is just if we have fiscal and monetary stimulus and this influences a weaker dollar, and it's not that straightforward, but let's just assume for a minute that this does lead to a slightly weaker dollar, which we have seen a bit in recent weeks. How do other central banks react to that? We've already gotten a few comments from the European Central Bank that it's not terribly happy about a stronger euro. And does it lead other central banks to review their own mandates? And I think Elga is probably in a great position to comment on this later during Q&A. They're doing their own strategic review at the ECB. If we have a number of central banks saying, I don't want a strong currency because that's deflationary, I want to try to encourage some inflation, everyone's trying to push their currencies down. Well, that's something that could create inflation. And then what do you buy? If all currencies are going down, that leads to more demand for real assets. And we've been hearing a lot about it this year in the press. Gold is certainly going to be a beneficiary of that. We've seen this movie before. We saw gold appreciate against a basket of currencies after 2008, and we certainly saw it in the 1930s when we also got explicit currency devaluation, in part to try to reflate economies. But Kim, why don't I stop with my formal remarks there? I want to make sure we have some time for all the great questions that came in.
That's great. Thank you so much, Rebecca, and thank you, Elga and Julia. Really excellent comments. Let me just mention to the audience, if you wish to submit questions, please do so using the Q&A device. A few of them have come in, but I should mention right away, we've got a lot of questions that came in advance of today's forum from students and faculty, and we're going to start with those. So I will do my best to pay attention to the Q&A box, but we have plenty to talk about. So I want to start off with the most general question and give each of you a chance very quickly to identify what you think is the single biggest risk to the outlook. And I want to focus on things other than the pandemic, which has been so critical for the outlook. So why don't we do this alphabetically the way we started? Elga, how would you respond?
I think a big risk is that we're starting to see some policy fatigue. We already see sort of a fiscal cliff in the US, where it seems to be more difficult than at least I expected to get some of the support via the federal top-ups for the unemployment insurance system extended. And so I think policy exhaustion, policy fatigue, I think given how crucial the policy support is for us avoiding major scarring of the productive capacities in the long run would be my main concern.
Great. Julia?
So I endorse that as a big concern. I think it is a big downside risk and is very likely. I don't expect a fiscal package, and I think it's going to be a hit to the economy. But I'll add to that sort of, I think that we've been seeing the undermining of U.S. institutions that underpin global capital markets. And just sort of the the integrity of the U.S. governmental system. And I think we're at a crossroads. And I generally try not to be political, but I think that we are at a crossroads. And I think that I expect the election to be very fraught and maybe foment some unrest. And I see tremendous structural risks in the U.S. And again, these are the institutions that have underpinned global capital markets. So I have a lot of concerns about that.
Great. Rebecca?
So those are both good concerns. I would share those definitely, particularly in the short term. And maybe I can just add two more real quick to the list of things to keep us all up at night. One would be that it's going to be very hard for policymakers to get out of this. You know, we've seen over the years with the Fed, for example, 2013, when it just hinted that it might want to start tapering quantitative easing, we had a sell-off in equities, a very rapid rise in bond yields, a big sell-off in emerging markets. We saw a similar reaction to markets in 2018 when investors thought the Fed had gone a step too far. I mean, the Fed funds was only 2.25%. It's not exactly high. And yet you had this reaction from markets that I think possibly contributed to the pivot that the Fed then executed. And so here we are with these huge central bank balance sheets, zero or negative rates, these huge budget deficits. Are we going to be able to unwind when the time comes, or are investors going to punish and then people are going to get stuck? That's something that keeps me up at night. Then very quickly, a second one, there's so many. But a second one would be U.S.-China relations in terms of, we had the trade war. We still have remnants of the trade war ongoing. it now feels like this is morphing more into a capital war, whether we're talking about TikTok or Huawei, or the US saying endowments maybe should reconsider investments in China and their portfolios. Where does this lead? And if we have a true tripolar world or bipolar world, is that stagflationary? What are the economic and market impacts of that? So that's more of a longer term issue, but definitely something else on my radar.
Great, thank you. All of you highlighted to one degree or another the enormous stimulative packages coming from monetary and fiscal policy and the impact they've had on financial conditions. So the question to ask each of you, as either as asset managers or as advisors to asset managers, if you were managing a portfolio and trying to judge what your share of equity should be in the portfolio compared to a year ago, how would it be different? Someone want to jump in first?
I can kick off. I mean, I'll plagiarize GMO for a minute, and they had a great title for a research note called 75-25 is the new 60-40. And what they mean here is that if you had a traditional portfolio that was 60% equities, 40% fixed income, in today's world where nominal bonds aren't getting you the return you need anymore, if you're trying to get a certain return target, it's forcing you out the risk curve to try to get to that return target you need. And so you're going to be taking more equity risk. And when I think about, I think we all talked a little bit about the real economy versus the financial markets today. Why are equities up so much when we have an unemployment rate close to 9% and the real unemployment rate is much higher? How can that be? Well, part of it is with yields where they are, I think some investors feel forced to own more equities in their portfolio to reach that return target. So that asset allocation shift is supporting equities perhaps beyond where they might have otherwise.
Okay. Julia, did you want to jump in on that?
I mean, I'll only add, I think that sounds like sound thinking. I tend to, try not to make portfolio recommendations, but I mean, I think we are in a world where the Fed put is very much alive. But it also means that, both the reality for bonds' ability to rally and equities' ability to rally further means that future returns, no matter what you buy, are probably going to be lower.
Elga?
Yeah, I would also lean into a similar direction as the one that Rebecca outlined, but I would also want to stress that we should look beyond just equities versus government bonds, which clearly are sort of becoming less and less attractive. Also, not just for return purposes and the lack of coupon, but also because one of the key jobs that they're supposed to do in portfolios is basically provide ballast when we have that volatility that we have seen on a number of occasions recently, where they basically help you to offset some of the risk positions, notably in equities, that you're taking. And the closer that government bonds seem to be to some lower bound, that's partially predicated also by the lower bound for policy rates, the less they are able to do this function, perform this function, and rally when things are getting bad. And that's, I think, means that you need to tilt away from government bonds. But then there is, of course, also credit to consider. And at the end of the day, you need to have a holistic approach to the overall portfolio, and I think increasingly also need to look beyond traditional asset classes, liquid asset classes, and look at things such as private equity, private markets, and so on.
Great. Let me direct this question first at Julia. Julia, you spoke at about the Fed's strategy review, and you suggested a little bit of uncertainty about whether it would lead to higher inflation. Mm-hmm. Whereas, and it's my job to draw the contrast, I think Rebecca and Elga were both thinking that the new paradigm is going to be associated with somewhat higher inflation. First, it's worth exploring that a little bit, but to pose the question more aggressively, what do you think the Fed should have done? Should they have done more in their strategy review? Should they have changed strategy more aggressively in some way?
So I'll take the last one first. I think the Feds moved, I think that they did a great job. I think that they moved in the right direction. I think it was, as much as can be expected. I think the shortcomings for the Fed are in their toolkit. I think that they may need new tools in their toolkit to get the job done better, more effectively, more efficiently. So inflation. I think when we think about inflation, you want to distinguish between level shifts in prices. So one reason, for example, people were concerned about inflation in the COVID crisis was that we had all these supply chain issues, right? There was like issues with food processing and transportation. That's not inflation. Those are price level shifts. If the price of meat goes up because processing becomes more expensive because you have to do it more slowly, that's a level shift in prices, and that's a relative shift, and it sort of washes out. It doesn't keep going over time. Inflation is the process of prices rising continuously over time. And to support that, you need purchasing power to rise continuously over time. And we've been in a world where purchasing power has been not growing. The labor share of income has fallen, did not recover as strongly. And so if we're talking about moving to a world where the inflation process is going to shift to a higher level, it has to be matched by purchasing power. And this is where some of the inequality stuff and the demographics become a constraint. And we saw that in Japan in terms of the demographic influence. Older people don't like inflation. They, insist that their policymakers look for ways to lower healthcare inflation, prescription drug prices, et cetera. So there is a demographic pressure for lower inflation. And then the globalization and the limitations on labor bargaining power mean that wages haven't even kept up with productivity growth in the last few decades. So, that something needs to change there for me to believe that we're going to move to a higher inflation paradigm. Now, I like Rebecca's comparison to, the shift in the 70s, where like all the policymakers, inflation was so high, it was so bad, that policymakers globally and fiscal and monetary sort of focused their attention on lowering it. And we are seeing policymakers focused on raising it. So will they be successful? There's a better shot than there has been before, but it has to get at purchasing power. So if you tell me we're going to implement universal basic income, I will believe we're moving to a different inflation paradigm. But it's going to take something like that, in my mind. Okay.
Elga, let me turn to you for a moment. Rebecca mentioned that the ECB is also going through a strategy review. I think they're due to report next year, so there's some time. But following the Fed's strategy review, do you think the ECB should be making changes, and if so, what?
Yes, I think the ECB needs to clarify a few things, but they have given themselves a somewhat different and actually much broader remit on the issues that they're looking at in the strategy review. So than the Federal Reserve did, also extending to aspects such as climate change and so on. So there's a lot more going on in terms of the width of topics that they will discuss. But let's just zoom in on what it means for monetary policy traditionally, or if you will, narrowly define. The ECB, I think, is still struggling to really make clear that its inflation objective or price stability objective, which is how they like to refer to it, is symmetric. And I think there is still this debate as to whether, if it's undershooting in terms of the inflation outcomes, that's fine. And I think given how quickly we are eroding monetary policy room for maneuver, that needs to sort of be addressed. And then the question is whether, as you're doing this, whether you actually, you're also moving the center point, the midpoint of the target, or the target, to be precise, just to 2%, and go away from what originally, as you will remember, was up to 2%, which caused people in the 2000s to believe that everything that isn't deflation and below 2% was fine. Then in 2003, in the last review, they, based on a lot of sort of empirical analysis that they had done, sort of realized that they needed to make clear that it should be just below 2%. But to basically make clear and codify that it's symmetric, I think is important. The ECB has some way to do a soft version of average inflation targeting, because they always insist on targeting their price stability definition over the medium term. Who says that the medium term is 12 to 18 months? It could easily be considerably longer. So there are a number of things, I think, that the ECB also needs to look at in order to make sure that it can regain a more monetary policy space. And one important aspect, which will be a lot more tricky, I think, in Europe, is also how to best coordinate with fiscal policy, and how to go about it with, having more than a dozen treasurers sitting across the table, and so on. So there are a number of additional aspects over and above, I think, the one that the Federal Reserve had to consider. Great.
Let me turn back to an issue, Rebecca, that you raised. So I was hoping that you would explore it a little bit further. We're entering a completely uncharted territory in U.S.-China relations. Decoupling is going faster and further than I think anyone might have thought just not long ago. And I'd like to hear you just talk about what you think the outlook is for China's relationship to the rest of the world, and where you're, as you described it, the risks compared to that base case.
That's an easy, straightforward question, Kim. Thanks. So, what we seem to get some evidence of, although I think it's early days, is kind of this tripolar world where you have kind of a China sphere, you have a Europe sphere, you have a US sphere. They're all very large economic blocks. They all have their own center of monetary policy. I think you've seen China's really stand out during the pandemic. They've definitely not followed the crowd in terms of quantitative easing or extremely easy monetary policy. They have some of the most attractive bond yields out there now among the major economies. But what we were watching is early in this, when you saw a lot of pushing, particularly from the US, that people need to diversify their supply chains. You don't want to have too much in China. And then when you see what's actually happened 6, 7, 8 months later, companies are wrestling with this because on one hand, they don't want to be in a political crosshairs. On the other hand, China is a huge center of demand, a growing and large consumer base. So you don't want to just say goodbye to that. So what we're seeing is some companies are just staying in China. Some companies are moving outside of China, but staying in the neighborhood. So they'll go to Korea or Taiwan or Philippines, Vietnam, et cetera. So they can avoid some of the political ramifications, but they can still benefit from the Chinese consumer base. And then you have other companies, if the U.S. is their main consumer base, maybe they're going to the U.S., or if costs are still a big concern somewhere like Mexico. But you're getting this, again, trifurcation, if you will, with the U.S., Europe, China, to a degree, not fully. What's interesting to me about this, as I play it forward, if it continues, is that China is developing even stronger trade and business links in the Asian bloc. And these economies may get more foreign direct investment flows, right, as companies put their supply chains there. So they're going to benefit. They're going to see more growth. And if they're growing, then they're going to be able to do more business with China. And it could become a virtuous circle, if you will, that benefits the Asian bloc, I think, quite a bit. So while there were some headlines early in all this saying, oh my gosh, China's going to get hit, all these companies are going to leave China, I actually don't see that happening at all. I think China could end up doing quite well, maybe just less directly than it had in the past. I think China's definitely very focused on developing its domestic economy, trying to reduce its reliance on the rest of the world, but especially the West, because it doesn't know where this is going. I think it's been fascinating that we've had remarks from Chinese leadership recently about the U.S. high debt levels, about their concerns with some of our fiscal and monetary choices. And I could see them trying to continue to internationalize the renminbi, perhaps through that Asian bloc in part, so they have their own center of strength. So they're not as reliant on us or the West if we have more taper tantrums or political tantrums or whatever comes our way. So I mean, China has plenty of its own risks and issues. I'm not trying to gloss over any of that. But when I have the bigger picture outlook, I actually think China is going to come out of this pretty strong.
Great. Thank you. I'm glad I asked you that question. Thank you for that. So let me try and highlight another area where I think there may have been some disagreement. Julia, you mentioned the idea that with low interest rates or low interest rates relative to growth, rising debt levels, public debt levels really aren't a big problem. My understanding from Elga is that, and actually from Rebecca's most recent comments, that there is some concern about rising debt and the willingness of investors to absorb it continuously at these very low levels. Where are we headed in medium term? Is R going to stay far less than G so that medium term debt issues are really very minor? Or are we going to find that investors ask for a larger risk premium to cover uncertainties about rising debt? Who wants to jump in?
Well, I can jump in terms of the remark I made. I mean, look, the Fed is providing lots of financing to keep rates low and can do as much as is necessary, barring higher inflation. And that's what looks very MMT about it, right? It's sort of an MMT light. And it's what Japan has done for decades. And again, what is the difference? Well, the difference is they don't do, fiscal policy doesn't do so much that it generates an inflationary environment. In fact, it's done too little, or the private sector has done too little, and inflation just never has arrived in Japan. They're fighting some pretty strong demographic headwinds in terms of generating it. And that's sort of a dimension of inflation processes that, I think is poorly formalized and understood, but it clearly empirically is a big deal in inflation, is the role of demographics. So, I mean, and when we look at kind of the flow of funds perspective, I know, the big story of, kind of Bernanke's global savings glut, right, was that China, the entry of China generating these gigantic trade surpluses that it need to recycle into dollar assets. And that was what was keeping rates low. Okay, and that we were at risk if China decided to, if the surplus went away and that dollar surplus went away, then rates would rise. But the dollar surplus did go away. China doesn't have as big a trade surplus as it did before. And what we're seeing is that the aging US population means that insurance companies and pension funds are buying treasuries. The banking regulation, a form of financial repression a la Carmen Reinhart, it means the banking sector is buying more treasuries and the Fed is buying more treasuries. So we are the master of our own interest rates. We have the levers to pull by the Fed or by, regulation to control interest rates. And at the end of the day, inflation is about the real economy and the heat it's generating. So I'm less concerned about it.
Anybody else?
I'm a little bit more concerned about it. At the current juncture, first and foremost, because the ramping up of the debt levels will likely constrain the room for maneuver for central banks to counter any inflation threats when they arrive. And the reason why I think they are more likely to arrive than Julia seems to think is that I do see a number of secular factors potentially sort of ending the extended period of disinflation that we have seen. So including deglobalization, for instance, which is a cost push factor. We're seeing increasing concentration in a lot of industries, which means that there are dominating companies that do have pricing power, which thus far they haven't really used that much because they have gone for scale rather than for profit margins, but that could change, especially if scale is more difficult to find in a more fragmented world along the lines that Rebecca just described, that sort of slowly sort of moves from a globalized world into one that sees more, instead of globalization, sees some regionalization of, economic relationships. And so that would be sort of my main concern, that then the constraints from a financial stability point of view, from political pressure, will be such that it will be extremely difficult for central banks to raise rates. And I have also sort of gone back and looked at the history and actually think that a very interesting parallel to what we see at the moment could be the 1960s, because we came out of a period of strong growth, very low inflation, a very flat Phillips curve actually, and then the Federal Reserve felt that it wanted to prioritize full employment, that inflation wasn't a problem, and that in fact you may be able to trade the two things off. And we all know what happened. The Phillips curve started to steepen, it started to shift up and up and up as inflation expectations started to increase. And I wouldn't rule out that even a flat Phillips curve starts to shift up as inflation expectations sit higher. And I don't think we can take a lot of comfort in the US or in Europe from the disinflationary or deflationary experience of Japan. I think there's so many unique factors that explain what's happening in Japan and why Japan ended up with a deflation that are very unlikely to be replicated elsewhere.
I would just say one of the key ingredients to the 70s was wages. It was a wage price spiral. Without wages, you can't sustain inflation.
I know, I would agree with that, but why should wages not increase? For instance, on the back of us starting to be more concerned about socially sustainable economic models, minimum wages, and so on. So
no, that's possible. I'm just saying that's what it would take, is a restructuring of the labor market, not just Fed money printing.
Yes.
So it seemed to me that all of you were thinking that, at least for quite a while, the new normal is going to be a large Fed balance sheet. And that sort of feeds into the next question I wanted to ask. And I'm happy to let whoever wants to jump in respond. If the Fed concludes it needs to ease aggressively further from where we stand, what should it do?
I mean, I think that's part of the problem right now. And I think it's been really unusual to hear people like Chair Powell and almost everybody on the FOMC openly calling for more fiscal policy. I've never, in decades watching the Fed, I've never heard anything quite like it. And I think it's a reflection that they know they're kind of at a limit. So, I think that that was the question some people put up. I think if the Fed, like, let's say we don't get the fiscal package and the Fed knows the recovery isn't going to be as strong as it wants it to be, what can they do? Will doing more QE stimulate the economy? I mean, they can't. They're talking about things like extending the duration of their bond purchases. Okay, so at 65 to 70 basis points, the 10-year yield isn't high, but it could be zero. So they've got some scope to do more, but I think all else equal, they think that the delta from policy to the economy is so much stronger and more direct with fiscal, and are hoping to avoid that next acceleration.
I agree. I think I totally agree with that. I think if there's one takeaway I have from this conversation, and it's so great to talk with you, Elga and Julia. I haven't had the pleasure of doing this with you guys before, but I think there's a loud consensus that all roads start and end with fiscal, that we have moved into a new world where it has to pick up the reins, but there's also a lot more risk around it. And we're seeing that with the fiscal talks right now. I mean, the Republicans are coming in at $300 billion and the Democrats are still holding out for a couple trillion. And we may end up with something, or we may end up just with a continuing resolution and a bunch of people sticking their tongues out at each other for a couple months.
Mm-hmm.
But don't forget that also the Federal Reserve has the option to take quasi-fiscal measures, which they did with a number of facilities that they pushed out on the credit side, where they directly fund corporates, where they directly support a range of different activities, including local governments. So at the end of the day, I think if push comes to shove and fiscal sort of falters, central banks will need to do more quasi-fiscal stuff, really stretching their mandates. And it was interesting, Julia, when you mentioned that Chair Powell sort of called for fiscal, it reminded me when the Bundesbank President Weidmann was calling for higher wages and basically suggested that trade unions should do their job and really get some wage increases going in Germany, which was a couple of years ago, when we were also stuck in a very low inflation channel. So that's sort of the central bankers crying for help, so to speak.
Yeah.
Because they know that the next choice is that
similar, trying to urge companies to give wage raises.
Yeah.
Like trying to juice that inflation expectations wage price channel because they can't do it without it.
Let me just ask a quick yes or no question, because I have one more that I'd like to follow up with. But imagine that we've heard comments that the equity valuations are relatively high. Imagine that for sometime in the next 6 months, the U.S. equity market and other equity markets fall and plunge in a serious way, more than a 20% decline. Do you think, and this is a yes/no, do you think the Fed will use its emergency powers to buy equities?
No.
That's it. One no. I didn't hear you. I got Rebecca's a no. Julia?
No.
No. And Elga?
I doubt it.
So actually there's uniformity.
Oh, that means they will.
Okay. Well, it does tell you that if you're all right, that there are limits to what the Fed's willing to do in its quasi-fiscal role in current circumstances. So it's worth keeping in mind. So let me close with one question that's really about our audience. A lot of people in the audience are our students, and I'd like to ask you what advice you would have to give students who are thinking about careers in economic and financial research, the kind of work that all of you do, or more broadly in finance. So, Rebecca, let me start with you, since you're the MBA from NYU.
Well, they've already made a great decision in terms of where they're learning their trade. So well done on that. I think I would say read, especially history. and learn to be a good communicator. I mean, it's obviously important to get the tools, to know how to do econometrics, to understand core economics. Of course, that's important. But if you can't communicate your thinking to someone in plain English, you're not going to be able to get very far with that. So take that 1 or 2 communication classes, or find a way to practice speaking to people or writing. I think for whatever you do with your life, that's critical, just to be able to express yourself clearly. And I say that very, very biased because I was a journalist before I went into finance 25 years ago. Then the history. I mean, it's amazing to me. You look at the election, I find myself studying 1876 and Rutherford B. Hayes. You know, I'm trying to understand inflation and yield curve control, and I'm looking at the 1930s and 40s. We're all studying the 1960s. You know, it's history doesn't repeat, but we all know it rhymes. And so understanding history can help you see where we are today and where we might be going. So I'd say make sure you get your history classes in there too.
Great. Julia?
That's such excellent advice. I love all of that. And I would add that to that, I will just add like economics and economic research is pretty recession resistant. So if you're looking for a resilient field, you know, it's not a bad choice. And then I will add to sort of the philosophical elements of Rebecca's, you know, advice is to stay flexible. So I totally agree with communication and knowing history, and also be flexible in your thinking because things do change. So you want to acquire toolkits, but those toolkits are going to move on you. And so you're trying to kind of distinguish what is the underlying thing that you're trying to get at, and the tools are just a means to that end. And to stay flexible in your thinking and your approach, and to learn as many different approaches as you can to solving a given problem.
Great. Elga?
Yes, I would sort of underwrite all the things that the 2 co-panelists have already mentioned, but I would stress also the breadth of economics, also in the financial industry, and how quickly it evolves. I mean, imagine all the things that even we, having left university decades ago, are still learning every day. So, I mean, research, first of all, is the best place ever, because you are learning every day about exciting things, and you are posing yourself some very pertinent questions and are trying to find your answer to the questions, and then get to debate them with other smart people. And what is actually driving, especially financial outcomes, investment outcomes, is changing so rapidly now. The whole sort of move towards ESG, towards sustainability, will create a completely different set of research needs within finance and economics, and who knows what sort of the needs are in 2 decades from now. And the technological advances in terms of how we look at data, what kind of data we have at our fingertips. I mean, when I first started in this business doing German economics, we literally had somebody at the statistics office read out to us the quarterly GDP numbers, and one of us would punch them into a computer to quickly calculate what this all means for the current year. We would receive stuff by fax. I mean, it's ridiculous in today's day. So it is just, you're in for a wonderful, wonderful ride, and really find the part of it that really sort of floats your boat, what excites you, because that will most likely be also of interest to a lot of other people.
Thank you all.
It's a great place for women. Sorry, last point.
Great point.
Great place. Research is a great place for women because you sort of are the expert, which means you stand out in the crowd if you don't do already.
Well, that's a really wonderful place to conclude today's talk. I want to thank all of you. I'm sure our audience would be clapping for our distinguished panelists if they were in the same room with you. In about 2 weeks, we will post a video of today's program on the center's website. And I'd like to just send a message to the audience. We hope to see all of you again at upcoming center events, all of which will be conducted this semester starting at 5 p.m. Let me list 4 of them that are coming up in the next month and a half. On September 23rd, we will have a panel on U.S.-China relations. On October 6th, a panel on the LIBOR transition. And on October 15th and 27th, we will have fireside chats with the president of the Minneapolis Fed and with the IMF Director of Research, respectively. So thank you very much for joining us today, and a big hand for our panelists. Thank you very much.